The right advisor for you is one who will make and take the time to understand what drives your financial journey and help you design a holistic plan that helps you progress towards your specific goals. The wrong advisor, on the other hand, is one who pushes proprietary products from a limited menu for their benefit without considering what's best for you. And at the end of the day, what will help you achieve your individual goals. Let's start off with some market updates, guys. Let's kick things off here. First things first, we'll talk about some good stuff, some bad stuff, and the ugly. Big job cuts. You see us talk about on webinar after webinar. We talk about two things often, and that is we talk about the inflation projections. So we know what the Federal Reserve is up to, and then their other half of their dual mandate, which is the employment sector. We saw some big job cuts announced this week. Unfortunately, Amazon, 30,000 jobs, Walmart, 34,000, UPS, 48,000. Hello to everyone joining us. Thomas, Shauna, welcome. As everyone's joining us here, drop where you're coming in from. We want to hear from you guys. Also, while everyone's getting settled, we are in week 3 of the government shutdown. What a wild time to be alive, huh? It is interesting. That's the good news. We saw a few interesting things this time around. One, this is one of the longer shutdowns with no direct end in sight. Today, we saw Congress not pass the 13th funding bill that was on the docket. So very interesting to see a relative gridlock. We'll see if they can meet in the middle and get this country back on track. Last webinar, we talked about how there are case studies where economies actually flourished well during government shutdowns. We saw Belgium, we saw Spain, but largely this could cost us quite a bit. So we want to get this government back up. Another interesting one. Trump seems to defy all logic at times for pros and cons and everything in between. Trump's approval rating, even in the middle of a government shutdown, has been steady. So he leaned into the strategy of saying, hey, this is, the Dems problem. It's their fault, blah, blah, blah. We've seen that a million times in the past. That's nothing new. This time it has maybe landed, maybe hasn't, but we haven't seen his approval rating go down during this. So it seems like tensions are high on the government side. And next, because we always talk interest rates, there is a 92% chance that the Fed will cut interest rates at the next meeting. Only 2/3 of people believe this should happen, however. So this is not a super high number. And there's a 38% minority that actually oppose a rate reduction. In the past, you guys may have heard me say I was not in favor of rate cuts while we were still dealing with, some high inflation after the dollar's gotten its butt kicked in recent times and over the last year or last handful of years, if you look at, purchasing power and the amount of money printed. But still, it looks like with the unemployment concerns that they're leaning heavily to support employment. So I've changed my tune on that. I think we need to support the labor markets. I think we need to be supporting and fighting unemployment at this time. So interesting headlines. Welcome to those that are piling in now. Good to see y'all. All right, let's kick things off. Today's webinar is what your broker doesn't want you to know. We have gotten all kinds of questions throughout our experience at Saint from many people that had big questions on should they choose this broker, should we choose that broker. Really, that's not us for us to decide. It has to come from you, the investor. But we wanted to give you some things to think about today. So we're doing a deep dive on investment advisors, on your brokers, some good things to consider along the way. So we're going to be jumping into this amazing topic. The reality is that your advisor can shape your financial future much more than any single stock, any single fund, or any other investment. The wrong fit, someone who's misaligned with your goals or is compensated in a way that conflicts with your interest, can erode your returns quietly and massively over a long period of time. We're going to explore the good, the bad, and the ugly of how financial advice works and how advisors are incentivized. So, quick overview. What credential your advisors should have and how to verify them. How to ensure that your advisor is making recommendations based on your interests. That's the most important thing here, your interests, not theirs. And why your advisor might not be recommending alternatives like private equity or like real estate when they really should be. Warren Buffett said one of my favorite quotes of all time. I say it on many webinars. Show me the incentive and I'll show you the outcome. I want you to be thinking of this quote throughout this call together. It means simply that human behavior is based on incentives. And investing, it's about making sure the incentives of the broker match your financial goals along the way. So understanding your broker is how your broker is compensated is critical throughout this presentation, especially their incentives. So you may or may not need an advisor with particular credentials, and we'll talk about what the various certifications, we'll talk about the various licenses, what they mean to you, and how to check your advisor's discipline and their history. And perhaps most importantly, we're going to talk about alternative investments like private equity and real estate and why your broker might not be offering these to you. But first, in case we haven't gotten a chance to meet yet directly, my name is Nick D'Angelo. I am president at Saint Investment Group here. I love these webinars. I love that our team does a deep dive on amazing topics. And I'm blessed that I get to be considered a thought leader in the space. I get to appear on podcasts and stages all over the country. What I'm most proud of is our performance for investors, bar none, no question. So as you can see, a little bit of some of our stats here. We have over 600 mortgages in over 29 states and growing, over 211 million in assets under management. That is because we have never missed a distribution. That has been for over a decade, and with returns that we're super proud of, 12 all the way up to 14.28%. So we like to brag a little bit and say always on time, every time. And this is more data on us, what we've done, kind of a little bit about our background, a little bit of our resume. So again, over 14 million distributed to investors, over 131 months of consecutive distributions. That's over a decade. And most importantly, lots of happy investors. But I always encourage you guys, and this is a big point of today's presentation. Don't take my word for it. Am I biased? Absolutely. I think Saint's the best company in the world. I think what we do for investors is the best in the world. I think we're best in class. But I encourage you guys to look at what investors have to say about us. That's, again, a big theme today. So there's a few places you can check on what investors have to say about us. I recommend Trustpilot. I'd recommend Google. We have, 50-something reviews from people that have worked with us, and you see some happy faces on the screen there. But before we get too far, I wanted to take a moment and introduce you guys to a very important member of the Saint team, our very own Tom Furlong, who is the Director of Investor Success. So Tom, can you hop in and tell the audience what you do at Saint and how you can help them out along the way?
Absolutely. Yeah, thanks, Nick. So my name's Tom Furlong. As Nick mentioned, I'm the Director of Investor Success. I work specifically with the income fund, really helping investors navigate their own investment portfolio. If you have questions on how your investment roadmap should look, or specifically about the income fund, that's what I'm here for. So I see a lot of friendly faces, a lot of people that I've talked to already, but some that I haven't. So I'll drop my contact information directly in the chat. So you can send me a text, send me an email, book a call with me. If you're a current investor and you want to send me an emoji or something, do that. I'm always happy to just link up at all times. But yeah, I've raised background on myself. I've raised over $200 million between institutional money and retail investors. So I am a good resource to have. And now with this income fund, on time, every time, we love to show it off. We love to talk about it. So I'm happy to talk with all of you.
Tom, we appreciate you. We appreciate you. Tom is literally the director of investor success. He's an amazing resource. His goal is to make sure that you guys are confident in your investment, get you all the details over. He's worked with hundreds of millions of dollars. So at any point throughout today's presentation, you can reach out to Tom. You can either call him directly or book a time in his calendar link that works best for you. So you see that in the chat there, and you guys can get some time on the books with Tom to learn more about investing with Saint. So here's the breakdown for today. We're going to jump into a legal disclaimer. We're going to keep the attorneys happy. Then we're going to knock it out of the park with this topic and really jump in about the advisory industry and some really powerful things to consider and understand. We'll go through some brief housekeeping, and then we will be shifting into live Q&A. So if you have questions on the topic, if you have questions on the economy, investment strategy, the Saint Income Fund, Saint in general, me in general, anything and everything is on the table. So please let us know. The live Q&A, we consistently get fantastic reviews on as one of the best opportunities for us all as an investment community to compare notes. So I'm really excited for that. So a quick word from our legal team. I encourage you guys to read the slide here, but this is not investment advice. This is for educational purposes only. All investments carry risk. Past performance does not ensure future results. And then throughout the course of today, I'm going to be going through a ton of numbers, especially in the Q&A at the end. I always try to give as much data as I can when answering questions or talking about the market. So please verify these numbers. They're coming off the top of my head at times and can be pulled from memory. And then also, we spend a lot of time on these to give you guys the best information. So I just want to make sure that you know that everything here today is the property of Saint, and we want to make sure it's not reused, etc., so we can keep bringing you guys amazing content and information. And then I love this section. We have an ongoing book giveaway in every webinar. Our goal with this book giveaway is to give really kind of extra credit and extra deep dive opportunities for people that really want to learn more about the topic at hand. This month's book is What Your Financial Advisor Isn't Telling You by Miss Liz Davidson. She has a huge background in finance. She runs Financial Finesse today, which is a company that leans into, navigating with some of the best financial education in the space. So she did a deep dive on this exact topic that would be further reading. If you want to buy the book, you can use the QR code now and take a look and buy it on Amazon, or we're going to give it to you for free if we can get you guys to engage and hop in and have some great conversation with us along the way. So ways to engage and win this month's book: comments in the chat, questions in the chat, responding to polls, and leaving reviews. Those are the best ways for us to get you this book. We don't have a set number that we give away. We just give it to the best, most engaged people throughout our webinar. So I encourage you guys to hop in and, have some fun in the chat, and we can kind of go back and forth on this good topic. So let's kick things off, huh? Why is this so important? What's at stake when choosing a financial advisor, and what things should you be considering? Choosing a financial advisor can be one of the most important financial decisions that you make in your lifetime. Unfortunately, it can also be one of the most confusing. The industry has a ton of jargon. You see endless, glossy, beautiful performance reports, but oftentimes things like incentives and fees are a little bit less clear for the investor. So today we will pull back the curtain and we will give you guys the tools to spot whether the person that's managing your money is truly working for you. First things first, the number one step to begin this process is to understand your financial goals. This is all about you. Every investor is motivated by personal objectives, and that's really how it should be, right? These are governed by personal risk tolerance. These are based on individual circumstances. The right advisor for you is one who will make and take the time to understand what drives your financial journey and help you design a holistic plan that helps you progress towards your specific goals. The wrong advisor, on the other hand, is one who pushes proprietary products from a limited menu for their benefit without considering what's best for you. and at the end of the day, what will help you achieve your individual goals. You'll need different strategies at different life stages, and you will want an advisor who will progress with you during these stages and help you move through each life transition along the way. Your objectives when you're starting out, like building a career and a family, etc., are likely very different as you approach retirement, for instance. At this stage, you're thinking about the rewards of hard work in your retirement years and the legacy you want to leave while enjoying a very high degree of financial security so you don't have to worry about financial concerns in your golden years. So, choosing the right person for these different stages is going to be paramount. So this is a fun slide. It's a breakdown of the ABCs of the different advisors. So advisors may use one or more of this alphabet soup of designations, but we'll go through the top ones here. First, we'll go through CFP, a certified financial planner. These individuals focus on holistic financial planning, including retirement, taxes, insurance, and investments. Then we have CFAs, Chartered Financial Analysts. They specialize in investment management and analysis. So really, they're more common for looking at your portfolio and really general financial planners overall. And then we have certified public accountants. So they typically cover tax matters and tax planning. However, and here's a big however, credentials alone are not going to guarantee excellent client outcomes. An advisor's experience, the practical application of their knowledge, them doing this across different sectors, across different market conditions, and across different client circumstances. These things often hold greater or hold equal or greater weight when you're making this decision. Good advisors are not made from just studying really hard and passing a test. The big takeaway here is to find a professional that fits your needs along the way. For me personally, I've spoken with and worked with all of the above, and I can say that one for me stands out above all others. So I'm going to ask you guys an interesting question. For me personally, which one on this list do you think I speak most to for my personal portfolio? Not for Saint, but for my personal portfolio. Which one on this list do you think I'm talking to most consistently? Leroy, good answer. Darius, good answer. I'll give you guys a hint along the way. So I've been in the investment world for over 20 years, and I've had the blessing to learn directly from portfolio managers and investment strategies, from the heads of family offices. So I've gotten a good education along the way. All at different times. CFA, good notes, good notes. So all that said, I'll put it this way. I run regular risk assessments. I run Monte Carlo projections, all that. But the reality is that my comfort level is pretty high when it comes to different investment scenarios. So where does that leave me? On this list, I personally speak to more than any other person, my accountant, more than any other advisor mentioned. I'm comfortable with the portfolio side. I'm comfortable with the investment side and do a ton of due diligence on investments. But the tax implications of investments are extremely layered. And knowing the tax ramifications is most important for me to get from a professional along the way. So the last thing I want is a tax surprise at the end of the year. But we'll zoom out a layer. If we're talking overall for most people today, the likely best financial advisors blend all three elements here. We're talking strong credentials that show their competence and their hand in the market. We're showing, and then as well as extensive real world experience to make sure that they have sound judgment when making their calls. And then also an unwavering fiduciary commitment that prioritizes the client over all else. So, how do Americans find and hire financial advisors? It turns out there's studies on this. Turns out there's data, which we love data. We love leaning into the data here. We see that 96% of people referred to a financial advisor will research them online before making contact with that advisor. We also see that over 80% of people want to read online reviews about financial advisors. We see that 97% of consumers plan to contact two or more advisors before making a hiring decision. And we see that a third of people said an advisor's location doesn't matter as long as they prefer to meet exclusively online. So it's important to verify the credentials and make sure that these potential advisors are up to snuff. But it's also very important to make sure that you're getting recommendations from various sources along the way, and reviews consistently are one of the best research tools that investors are using. That's why I said check out our own reviews at Saint, right? Because as a case study, this is why we push people to reviews at Saint, so they can look past our bias on the company and see what other people have to say about us. We know that we have a very high expectation of what we're doing and very proud of it, but we want to see that people see from third parties that we're dedicated to our investor success. So in the same way, we see Americans are being more resourceful than ever with how they're vetting and getting third-party reviews of financial advisors. Now that we have that out of the way and we have a little bit of a foundation of how to find a financial advisor, let's talk about billing methods that are used by firms most commonly. According to research from Kitces, we see that over 86% of advisory firms still rely on assets under management as their fee structure. This is roughly around 1% annually based on your portfolio size. If you're below their average, it might be a little bit more. If you're above, you might be able to beat them up on fees a little bit, right? But what's becoming more common in the fee structures is that many firms use a combination of fees. You can kind of see on the board and then the chart what that might look like. Industry research shows that there's no significant difference between total fees charged by advisors, whether they're using bundled fees compared to unbundled service fees. So largely, whatever the model is, on average, you're ending up roughly paying the same amount of fees at the end of the day. But here's the real concern: incentives. It's that incentives often shape the advice. A broker earning a sales commission is likely to favor, I don't know, mutual funds, annuities, etc., that have fees built in paid to the advisor. Because advisors are tied, advisors at the end of the day, they have payout grids. They can get bonuses for selling certain products. So this muddies the water of where their incentives really lie. And the worst part is often these fees are difficult to identify. And the advisory industry is not incentivized, by the way, to be clear on these fees. So drilling down on these will give you a better idea of what your true fee cost is at the end of the day. Here's an interesting case study in my own personal experience. I have a close friend who reached out to me in the last few months, actually, so this is pretty recent, to help with his father's portfolio and understanding why the balance was so low of the portfolio when they were really expecting it to be much higher. And again, this is not me making a fee or making any money on this, but it was just a favor to a friend. What we found out was that over this man's lifetime of working with this financial advisor who he's been with his whole life, he saw that his portfolio was nearly the same value as the amount of cash that he put into the portfolio. Meaning that if he put in 2 million over his lifetime, he had roughly 2 million in account value. That is brutal. So what was the culprit? It turns out that my friend's dad had not checked the fees and had not benchmarked the performance of his financial advisor. He had basically let the advisor do whatever he recommended, which meant choosing the investments that the advisor received the most compensation on, even if they underperformed. This older gentleman realistically would have been way better off investing in fixed income at a high rate or the S&P 500 over his lifetime, and it avoided the advisor entirely. So this is an extreme example, but this is one that broke my heart to see, so I wanted to bring it up and show you guys. Tony, good question. Great question, actually. We actually cover that in a little bit, so I'll make sure. And if not, we'll deep dive if there's a specific question in there in the Q&A, but we cover that shortly. Thinking ahead of the curve, Tony. I like that. So financial advisor annual costs. We see a breakdown here: commission, hourly, flat fee, AUM. The takeaway of the slide is that you should be asking the smart questions. One of the best questions that we recommend asking is, would you be paid differently if you recommended something else? Really cuts through the mustard. If they're a good financial advisor, this won't be a big deal. And if they're a bad financial advisor, this will be a really tough question. So fees can erode the gains made by even the most successful investment choices. Here are ways that we can see different fees assessed to different investors. One, we see fee-only fiduciaries. They typically work under the legal obligation to put your interests first. So these are set fees, whether it's hourly or whether it's project-based, et cetera. Then we see commission-based brokers. They may also advise you, but they earn more when you buy or sell certain products. So if you're staying up at night and it's in your head and you're wondering why your advisor keeps, telling you to buy, sell, you feel like a day trader, they might be commission-based brokers, and that might be something you should be plugging into and figuring out what the deal is. And then the third we typically see is a hybrid model. It's a mix of both worlds. And by the way, that can be fine if they disclose exactly how they're being paid, but you have to be comfortable with it most importantly. So in this case, let's use an example. Imagine you're a mid-career professional. Maybe you work in tech, maybe you work in healthcare, you've got a decent salary. Let's say you've vested in some company stock options and you're still paying down a mortgage, right? So very classic mid-career professional. Let's say you want to maximize your net worth, probably a smart goal. You want to minimize your tax bill. You're thinking ahead to retirement, but you also are not planning to stop working anytime soon. So you do have some income along the way. A typical broker, especially when earning commissions, might focus their conversation on products that they're incentivized to sell. For example, they could be pitching you on annuities. Right? An annuity, for those curious, an annuity is a financial product that offers guaranteed income later in life, but it's really notorious for high fees, limited liquidity. Even a ton of front-end sales charges on a lot of those products. So unless you're close to retirement or have maxed out other tax shelters, this is a pretty unattractive tool for most people in their mid-career. But it might have a huge incentive for an average broker to be pitching that. Tony, this is the answer to your question here. A fee-only planner, they're paid a flat fee, either yearly or by the hour, et cetera. They have a different incentive, right? They're not paid more for putting you in one product over another. They're more likely to dig into your personal situation, offer a more wide range of menu options, and build a plan around your real needs. So in that way, Tony, especially specifically to your question, something like a fee-only planner is going to give you a wider range of options with a better menu because they're not incentivized on any single route. They're trying to make a bigger plan for you. So something like a fee-only planner might provide, evaluating, an evaluation of the tax impact of different investments, coordinating your mortgage and your cash flow, prioritizing tax-advantaged accounts, building a diversified investment portfolio, and then most importantly, in my opinion, is creating a wide variety of what-if scenarios. What if the tech sector falls off a cliff? What if you want to buy a bigger house? What if you're laid off before all these options vest for that mid-career professional? These are big questions that if you deal with somebody who's really sophisticated, they can give you good scenarios and good ideas of what that would look like. So we know how they're incentivized, but are you getting the real choices, or are you getting a limited, more reduced menu in the meantime? Are you getting pitched on their menu, or are you getting pitched on your real opportunities in the market? In addition to traditional choices like stocks and bonds, which are pretty much the go-to for most advisors, top advisors and sophisticated advisors will offer and recommend private market investments. These are typically including private equity, private credit, private real estate investments, and there are distinct advantages for them to suggest these investments, especially to balance out a portfolio. Alternatives, alternative assets, that's what we're talking about, the classification of these investments. They typically provide higher long-term return opportunity. They typically provide opportunity for more diversification benefits because private markets, private markets move differently than public markets like stocks and bonds. So there's a balancing aspect to that. And then also, they typically provide access to niche opportunities like specialized sectors or specialized firms in mature sectors. So this is essentially this is essentially where Saint falls into a portfolio. We are a specialized investment group within the real estate sector, a mature sector. So for investors looking for fixed income that's not based on the stock market, that want higher returns than bonds, for instance, we're a fantastic choice, right? But all investments come with trade-offs. And oftentimes in alternatives, you do have trade-offs. Things like less liquidity, things like different tax reporting. So you have to have your tax people on track. And often you'll see lockup periods where it's, multiple months or multiple years, et cetera, where the money can't even be touched. Now, the reality is you're probably getting returns during this period of time, but you have to be a little more comfortable with a little bit less liquidity on the front end. Yet, we see a lot of people shifting to alternatives, right? We see a shifting. Darius, I'm reading it. Let's see. That's a great question, Darius, and let me dive in on that on Q&A. Can we make a note, Ange, of Darius's question? That's a great question. I'll give you a full breakdown. I just don't want to lose. I don't want to lose track on this. The point here is with getting the real choices and digging in on the real estate and the private investments and private equity, the reality is more people than ever have their eyes on the private sector because they're seeing the writing on the wall with many traditional sectors. We have a shrinking stock market, right? We see that there's poor performance in the traditional 60-40 portfolio of 60% stocks and 40% bonds. That has eroded massively over time, right? And also, in addition to this, you're looking at traditional sectors where your advisor is pushing these without bringing up the broader economic impacts of it. But if we look at the case studies from the biggest groups, which we always try to do, we always try to include case studies from people that are doing things differently or ahead of the curve. If you look at groups like BlackRock, if you look at groups like Blackstone, if you look at groups like Tiger 21, which is a group of private investors that in order to be part of this club, you have to have a minimum investable cash amount of $10 million. Okay. They're not fresh investors. These are a very sophisticated group of people. If we look at these big groups, we see that the trend is moving away from traditional investments and moving towards private investments. The data is showing more of the bigger and more stable opportunities are staying private, while less companies are choosing to go public along the way. We see this with a number of companies in the stock market dropping by over 40% since 1995, while the private equity space has grown by over 6x during the same period of time. So many of the sophisticated investors are going with private investments over the public space as they learn how much the market is changing and how the stock market is less diversified than ever. When your advisor, so let's talk private equity, real estate, and other alternatives. When your advisor discusses private investments and other alternatives, they should be sharing information about due diligence requirements and liquidity limits. These are two of the most important factors to be considering along the way. Some advisors will simply avoid these options in the private markets, even for qualified investors, even for investors that would majorly benefit. Alternatives do make sense if you have a longer time horizon or are more comfortable with that initial liquidity period that we talked about. And you already have a core portfolio that you're comfortable with. If you have the foundation that you're looking for, then you could have more upside and more opportunity looking at alternatives. Also, if you can commit to capital you don't need to touch for several months or years, and your advisor can show you how the private investment complements your other investments. That's real sophistication here from your advisor, is for them really truly being able to analyze the market and give you feedback for a large scale balance of your portfolio. If your advisor is not able or not willing to guide you through alternatives, you are likely missing out on major opportunities that could balance your portfolio and boost your returns. So how impactful is the private investment world today? Well, it's getting so much attention, in fact, that the government is creating new options for investors to take advantage of private investments in their 401k accounts. This is groundbreaking and a massive change in finance. Today, 401k investments are limited to publicly traded securities, stocks, mutual funds, ETFs, etc. And this is as retirement pensions continue to decline among employers, right? We're seeing a major shift away from pensions, and we're seeing that 401k accounts have been the most common employer sponsored retirement benefit in the modern era. More than 90 million Americans participate in these 401k plans. So it has the attention of the government. This month, President Trump issued an executive order titled Democratizing Access to 401k Investors, which directed the Department of Labor to re-examine guidance under ERISA about alternative asset investments using 401ks. So the government's getting behind this, and they're now breaking down the barriers between 401ks and private investing for 90 million Americans that have a greater interest and want more opportunities in alternatives. So this is a potential game changer that we're seeing in the investment world, and it gives investors more access to more opportunities than they've ever had before. All politics aside, I view this as a major win for investors. We see the Magnificent Seven in the stock market make up over 33% of the S&P 500's value. There are a lot of concerns in the marketplace, especially with diversification as a big question. So with all this information, how can we manage our strategy and how can we update our portfolios along the way as studious investors? The best advisors treat meetings with their clients as a state of the plan check-in, not just a how did we do last quarter, which is kind of the normal conversation. That might be your guys' experience with your financial planner. That's definitely been mine. Returns are important to be sure, but they're a piece of a bigger plan for your portfolio. And anyone that has chased only returns and just basically put their money with what the biggest number was, what they can tell you is that eventually you start taking losses. This is caused by not being a well-balanced investor. So a good meeting with your financial advisor should break down both a review schedule and a decision criteria built into that meeting structure. Not just a, hey, I'm the advisor and we monitor it regularly. That is not going to be enough to make sure that you're getting the best advice. Advisors who can clearly explain their process for rebalancing, tax review, client check-ins, all of the above, they are demonstrating to you, the client, that they can manage your relationship thoughtfully and strategically and not just react to whatever's happening in the market day to day. Investment plans, again, should evolve with you and not sit frozen in time. So here's a strategy that we recommend you consider. The best advisors run at least one formal top to bottom deep dive review each year. We see that the best strategy is supplemented by quarterly check-ins with your advisors to make sure that you are on track for the goals that you guys set out to achieve. Not only have I found this in my experience personally, maybe a case study of one, but this is also according to industry research, best practices from eMoney Advisor and Russell Investments. You might have heard of the Russell 2000. So even the big names in the advisory industry support this structure. Let me repeat it one more time. One annual formal deep dive review per year with your financial advisor, and then quarterly check-ins to make sure that you're tracking and tying those two together for the performance, for your goals, etc. And when you're in these meetings with your financial advisors, what questions should you be asking? We wanted to include some, potential prompts for you guys to run by your advisors. How often do you formally review my portfolio on your own? Do you update allocations based on market shifts or personal milestones? What specific triggers would cause you to change my investment strategy? If inflation spikes, if rates rise, etc., what's your adjustment process? That last one particularly I love because it puts them in a place where they really need to show their chops on understanding the economy and how to react to it. You can use these questions as prompts to gauge how proactive your advisor really is. Because at the end of the day, your advisor should also be verifying that your goals are remaining the same over time so that they're tracking to what your goals are. Maybe when you started working together, for instance, your goal was to buy a boat and sail around the world at 45, right? But now maybe you have a spouse, you have 3 kids, maybe you have an maybe you have an elderly dog. I don't know. Whatever the case may be for your world, these changes may have changed the outcome, and your original objective might not be something that you can target today. So your advisor needs to be asking the questions to make sure that you're tracking to your goals along the way, whether those change or whether those stay the same. Here's some more amazing key questions and some red flags. Tony, that's a great question. We'll dive into it in Q&A. I've had that conversation too many times, by the way. A good advisor is a financial partner, if you want to think of it that way. They are not a salesperson. They're not trying to pitch you on their products. The right one is going to invite questions, talk about conflicts that they have, educate patiently, and most importantly, revisit strategy, like we talked about. So before you sign anything with any advisor, I recommend checking, comparing, and asking the difficult questions. You see a number of them in this slide here. The right advisor won't flinch when you do that. And at the end of the day, guys, we're blessed that we have a pretty sophisticated investment community. I would say with a group this smart, trust your gut. Also, if something feels off, don't ignore it. Dig in and get as much clarity as you possibly can so that your confidence is as close to 100% as it can be. So on our side, we get asked pretty regularly what the perfect strategy is. There is no perfect strategy. Let me start there. But if we were to give you guys what we see as a best case scenario, the goal is building resilience in your portfolio. Simply put, it's to build what we like to call an all-weather portfolio. It's something like imagining a scenario where if rates rise and if rates rise and inflation has this outcome and unemployment's that outcome, that you feel comfortable in all facets throughout the storm. What we see consistently as the best general strategy is balancing fixed income in growth. We've seen a huge boom in fixed income with the volatility of the market. So what we see in that case is an income fund as the number one opportunity, but most importantly, it's based on what asset classes that we're seeing in the market as the opportunity to invest in. The number one asset class, without a doubt, that we are seeing as the most stable long-term, 10 years, 20 years out, are single family homes. If you look at that market, we see a 6 million home shortfall. So the demand is high and the supply is low. We see that the government backs up over 80% of mortgages throughout some stage of that life cycle. They either own the mortgages, they insure, they guarantee, et cetera. We have HUD, we have FHA across the board. So for us, the biggest issue when we look at single family homes is that we love the market. We think it's the strongest market basically in the investment world today. The issue is, how do you invest across so many homes? What we like are single family mortgages to resolve that scenario where we can invest in the number one asset class and do it at scale with investors. So in that case, we see an income fund as the number one opportunity in today's market, and we put our money where our mouth is. That's what we're doing today to bring to the market as the best opportunity. We talked about an all-weather portfolio. So here's an interesting example. If rates go up, well, many different industries are impacted massively. What about single family mortgages? In the case that rates go up, we like mortgages because mortgages are actually more stable. There's less refinances. Cash flow is more stabilized because the homeowners are less likely to go move into a different home if they have to go pay a higher rate for their mortgage payment, right? So there's less turnover overall, and it's a more stable portfolio. But let's talk if rates go down, which is really kind of what we're looking at. That's why we always open with this, is to check in with you guys on rates and what you're seeing and what we're seeing. If rates go down, that's also fantastic. That's a great opportunity for us because the reality is it stimulates buying. It raises home prices. Equity is stronger. We already have roughly the most amount of equity in single family homes in history in the United States today. But if rates continue to go down, we'll see more people want to buy homes as they can afford more. On our side, as portfolio managers of mortgages, that's also great for us, right? Because at the end of the day, we buy mortgages at discounts. That's our strategy. So if you're buying an asset at a discount, and then someone, let's say, refinances or pays out that mortgage to buy a new home, that's great for us. We're getting paid full price on something that we bought at a discount. So that's great. It actually boosts returns on our side. What we found as the best strategy is to just go buy more mortgages, bolster the portfolio more. So we're excited for the rate drops. This is a good opportunity for us and our investors. And at the end of the day, if you want to learn more about investing with Saint, with our 600 single family mortgage portfolio in over 29 states with returns up to 14.28%, then I encourage you guys to get with Tom and have a conversation and learn more. Tom, do you mind dropping your info in the chat again here? And then also, we put out regular content, deep dives into economic strategy, deep dives into investment strategy, deep dives on topics across the board. The best place to find these resources is going to be our YouTube channel. So we encourage you guys, hit the QR code there and subscribe to the channel, and you'll be the first ones to know when we drop new videos, deep diving on various topics.